we looked at the meaning, the last time we looked at the meaning and the definition of accounting, and I think that's where we ended it. And we're looking at what? The features. Look at the definition, the process, and then we're also looking at the features. And we're saying that one of the important features or element of accounting is the act of what? Recording business transactions. Recording is very, very important. It's a very critical issue in accounting. So we'll look at it. It's also the act of what? Classifying. So number one, we are looking at recording. Number two, classifying business transactions. Number three, we are looking at the transactions and the events that must be recorded in what? Monetary terms. Our focus, our concentration will be on transactions, events, and business activities that must be recorded in what? Monetary terms. Then we are saying that it is also the art of what? Summarizing financial statements. The art of analyzing and interpreting transactions, and the result of these transactions must eventually be what? Communicated to what? Concerned stakeholders. This is the whole duty of accountant. That's what they do. It starts with what? Recording, classifying, summarizing, interpreting the transactions, and then eventually what? Communicating, informing the stakeholders. We have a lot of stakeholders, a lot of people who are interested in the financial issues of the organization, of the company. So at the end of every year, accountants need to prepare financial statements so that they release for the interested parties to study it and make informed decisions. So at a very basic level, this is what the accountants do. They do recording, classifying, summarizing, dealing with what? Financial transactions, interpreting, and then eventually what? Communicating. Communicating this information to what? The interested parties. Now, when we say recording, what do we mean? Recording in accounting, simply put, it says that this is the basic function of what? Accounting. Basic function. Fundamental function of what? Accounting. It is essentially concerned with not only ensuring that all business transactions of a financial character are in fact recorded, but also that they are recorded in an orderly manner. They are recorded in what? In an orderly manner. So, accounting begins with what? Recording. You cannot see that, oh, these transactions that have taken place, this business event, this business activity that has taken place, oh, for me, I can keep everything in my head. No, not at all. Even if you can keep everything in your head, it is still important, essential, critical for you to record the business transaction. On daily basis, we undertake business what? Transaction. On daily basis, every day in the organization. Transactions that involve what? Money in and out. And these transactions must be what? Recorded. Recorded. Yes, senior. Yes, he's saying that with regards to what? Recording. What do you identify and what do you record? Yes. Financial what? Transaction. So as he's saying, it is important for you to identify, but then before identification, the transaction must what? Take place. And we will come and look at the documentation. Documentation first. Are we okay? Anytime there is a business what? Transaction or business activity or event taking place in an organization, before you can go and record, you must have a source. And that is what we are looking at. You must identify the source of this particular business transaction. And the only proof, the only thing that can help you identify that, oh, this particular business transaction has taken place is when you look at what? The documents that are involved. For example, we have sold goods on credit to ABC Limited. When you sell goods to ABC Limited, or you have made payment of salaries to staff, it is not that you just call accountant, pay these people. There should be what? A document to that effect. Or you are selling goods, and then you say, oh, Master, come, you take the goods on credit, and then you will not what? Issue an invoice to that. No, not at all. So before you go ahead and do the recording, there must be what? A document to prove that this particular transaction, this particular business event, business activity has taken place. Then you pick the document and then you do recording, you record. And you need to identify the transaction because we'll come and look at it as we move on. There are a number of what? Business transactions that take place in the organization on what? On daily basis. Some are cash transactions. Some are also what? Credit what? Transactions. So you need to identify this one. Is it cash or credit? Well, if you are talking about recording, as we have seen here, it says that it is essentially concerned with not only ensuring that all business transactions of financial character are in fact recorded, but that they are recorded in an orderly what? Manner. What do we mean by orderly manner? Transactions that are for cash are recorded separately from transactions that are for what? Credit. Orderly manner. Some transactions are purely on sales. We are selling goods. Some are for what? Purchases. We can't just bring all of them together and say, oh, we are recording. So after recording your credit sales, then you go ahead and record what? Your credit purchases and so on. No, in an orderly manner. So if you are recording transactions relating to what? Sales, we are saying that you open what? Your sales what? Journal. Open a specific book that is exclusively for credit what? Transactions relating to what? Sales. You open that book and then you record. It means that you take the document, the sales invoice, and then you record these transactions in what? The sales journal. That's why he says that in an orderly manner, recording is done in a book that is called what? Journal. Recording is done in the book that is called what? Journal. So if we are going to record in an orderly manner, then we are looking at different types of what? Journals. So we'll have sales journal. We'll have what? Purchases what? Journal. We mean that all the transactions and business events that relate to purchases will be recorded in that particular what? Journal. The same applies to what? Sales, and so on and so forth, in an orderly manner. So, senior, it is very important to identify the transaction. Then, after the identification, you move on to what? The recording. The identification at this stage, we are looking at the type or the kind of transaction. Is it a cash transaction? Is it a credit transaction? Is it relating to sales? Is it relating to what? Purchases? Is it relating to any other business activity? So at this point is what we call journalization. The process of what? Recording business transaction is what we call journalization. It involves analyzing, identifying. Your point now comes here. So one component of the recording is what? The identification and the analysis of individual business transactions. And when it occurs, such as what has taken place, identifying the nature of the account involved, then ascertaining the rules of what? Debit and credit. Do we debit or credit? After the business transaction is being analyzed, they are to be recorded systematically in the book that we normally or usually refer to as what? The book of original what? Entry, or book of prime what? Entry, or book of first entry. They are all talking about the same thing. Book of original entry, book of prime entry, or book of first entry. They are all talking about the same thing. And one of them is the sales, journal, or the purchases journal. We'll come and look at each of them one by one. Now, the takeaway point here is that the whole process of recording a business transaction is called what? It's called what? Journalization. That's the takeaway point here. When used separate journals, they are referred to as what? Subsidiary what? Journals. Subsidiary journals. Good. Yes, sir. Yes. Let's take the lecture. When we are done, then we'll address them because we don't have time. We have only 2 hours. And we have a lot. You know, last week, we couldn't capture. So if we want to be addressing, then today it will be. And you know, when it's 10 o'clock, my professor will come and say, my time is up. So go. So please, we will address them one by one. So please, if you can note them down for me, the comments section. All right. After recording, the next point here is what? Classifying. Accountants do this a lot by classifying. When we say classifying your financial information, what do we mean? Classification is concerned with the analysis of all the recorded data with a view, with the aim to group the transactions or entries of one nature at one place. The work of classification is done in a book called, so from a journal, we'll move toward a ledger. So look at this. We are saying that journalization is done in a book, and that book is called a journal. Are we okay? Classification is done in a book, and that book is called what? Ledger. So have you been hearing the accountant says, oh, bring the sales ledger, bring the purchases ledger, oh, bring the general ledger, and so on. So when we mention sales ledger, simply it is just a book that contains the account of all our credit customers. Hello. So when the accountant mentions their term, ledger, please, it should not confuse you if you are not an accountant. It shouldn't confuse you. All they are saying is what? A book. Hello. That's what we are saying. All they are saying is what? A book. But the moment they mention ledger, some people get confused. No, that should not be the case. So when the accountant says, oh, I am bringing the sales ledger, or you can now say, accountant, there is an issue here. This client of ours is saying that we have overbilled him. Can you bring the sales ledger so that we can do some kind of what? Reconciliation? Accountant will say, hey, director, you know the temper? They say, yes, I know. Accountant, can you bring what? The purchases ledger. Go and bring the book that contains the account of what? Credit what? Suppliers. Those that we buy from on what? Credit. Go and bring that particular book so that we know how much we owe this guy. Please, are you getting the accountant their language? So they should not even confuse you. It shouldn't confuse you. Yes. When we record in the journal, we'll come and look at it practically. This one, we are just looking at the theoretical. I want us to get the basics. When you record the transactions in the journal, then you open accounts for them where you have the debits and the credits. You come and open the account, debit and credit. Okay. The account that you open for them, the account will also have a book that contains the account. Are we okay? Good. That book that contains the account, where you have the debit and the credit, is what we call the ledger. So we have the sales ledger, which is just a book. So normally from the recording from the journal, then we'll now open the respective accounts. The T, where is Senior? Where is the marker? Let's get us marker and the duster. So from journalizing, we'll go to what? Preparation of ledger accounts. So we'll have the sales ledger that will open accounts. So any time, any moment that we need a statement for a particular client, a particular individual, what do you go? We go straight to the sales ledger. We'll take that particular book, and then we can print the statement or the account of that particular what? Individual. If it is what? The purchases ledger is just a book that contains the account of all our what? Credit suppliers. Just a book. So all we are saying is that from recording in the journal, we get information from the journal, and then we use it to prepare what? Ledger accounts. Accounts. We open accounts for those particularly who have bought goods from us or who we have bought goods from. Are we okay? We'll come and look at the practical aspects from journalization to the preparation of what? The ledger accounts. And then from there, extracting your trial balance. And after extracting your trial balance, what next? What do? You use the trial balance to now prepare your financial world statements. And when you are done with the preparation of the financial statement, you will now release it to the interested parties for them to use it to make what? Informed what? Decision. Good. So we are saying that with a view of the growth, the work of classification is done in a book called The Ledger. Oh, come and look at it one by one. practically. So we are saying that classifying of financial information is concerned with systematic analysis of what? The recorded data. It also involves posting of what? Have you seen it? Posting of journalized transactions in the concerning ledger accounts by grouping them into the accounts that are similar in nature and then balancing them. Balancing them. It is worth mentioning here that the advent of computers has aided this process greatly, significantly. And the ledger accounts are balanced automatically when using a particular program developed for financial accounting purposes. Now we are no more doing this manual way of extracting trial balance and preparing financial statements and so on. Most institutions, organizations, and companies now have softwares of preparing what? Financial statements. So all these things are done by the computer. The next stage, so we are looking at it one by one. The first one is what? Recording. The next is what? Classifying. And then the third one is what? Summarizing. It says that this involves presenting the classified data in a manner which is understandable and useful to the internal as well as what? External end users of accounting statement. It goes on to say that the process leads at this stage, when we talk of summarizing, the process leads to the preparation of what? Number one, trial balance. Number two, statement of what? Comprehensive income. The preparation of statement of comprehensive income. Number three, statement of what? Financial position. Number four, statement of cash flow. And then finally, statement of changes in what? Equity. If you're in the public sector, then we'll be talking about what? Statement of what? Receipts and payment. Hello? In the public sector, we'll be talking about statement of receipts and what? Payment. In the public sector, we'll be talking about statement of what? Revenue and what? Expenditure. So in the public sector, if you're accountant in the public sector, you don't prepare statement of comprehensive income. They call it what? Statement of what? We run statement of what? Income and expenditure. Or revenue, all your revenue and all what? Your expenditure. It is different from statement of what? Receipt and payment. Hello? And these are the things you should know. What is the difference between receipt and payments and also revenue and expenditure or income and expenditure? Some of us, I think majority of us are in the public sector. Are we okay? Am I right? Yes. So then, when in the private sector, they mention statement of comprehensive income. In the public sector, how will this be mentioned? Yes. How will we regard this? Statement of what? Income and expenditure or revenue and what? Expenditure. Are we okay? In the public sector, statement of financial position, yes, is there. You also have statement of what? Financial position. Another name in the private sector for statement of comprehensive income is statement of financial performance. So if you are asked to prepare statement of financial performance, we are referring to your statement of what? Income and expenditure or statement of comprehensive what? Income. So it should not confuse you. When auditors say, we need your revenue and what? Expenditure statement. They are talking about statement of what? Comprehensive what? Income. We'll look at it as we move on one by one. When auditors say, oh, we need statement of financial position, simply put, all they need is what? Your balance sheet. Accountant, bring the balance sheet. Then you too, you can talk about it because you know what it is. Accountant, the auditor say they need this statement, but where is the cash flow? You have the cash flow statement, but particularly in the public sector, one of the cash statements that they normally prepare is the statement of what? Receipt and what? Payment. So what's the difference between receipt and payment and then revenue and expenditure account or statement? What's the difference between the two? Yes. What's the difference between receipts and payment accounts and revenue or income and expenditure account or statement? Yes. Yes, Honorable. Okay. Thank you. You are there. What's your name? Hafiz. Thank you. Hafiz is there. So we want to talk about what? Profit making. And the other one is purely about what? Inflow and outflow of actual cash. So when we say receipt and payments, we are talking about all actual cash, just like the normal cash book. All actual cash that we have received, whether in form of loans or from our customers or grants or donations from a particular entity or whatsoever. We bring all of them together, all our cash receipts. It's just like your bank statement. So please know the difference between receipt and payment account or statement of receipt and payment. And also what? Statement of what? Income and what? Expenditure. Receipt and payment only look at what? Issues relating to what? Or transactions or events or business activities relating to what? Cash. Inflow and outflow of cash. But revenue and expenditure or income and expenditure is not so. Income and expenditure looks at the bigger picture of the operations of the entity. So there are some non-cash items that you will see in what? Income and expenditure account. There are some credit items that you will see in income and expenditure account. But you won't see it in what? Receipts and what? Payment account. So are you getting the whole argument? And it's very important for us to know these things. A colleague of mine that some years ago we chatted together. It's a chartered accountant. So when these oil and gas companies were coming to Ghana, so Ghana, we have discovered oil. So these oil and gas companies were coming to Ghana, and one of them, is it Tullow Oil or Anadarko also? They called this guy for an interview. He was going to be their director of what? Finance. And as at that time, they were going to pay him $5,000 what? $5,000. That was 2010 or 2011 thereabout. Big, serious money. So he went through the process, and then at the final interview, they asked him a very basic, fundamental accounting question. What was the question? He said, "Oh, Chief, we have a question for you. And the question is this: cash is a fact. Profit is an opinion. Do you agree or disagree? If you agree, justify your answer." Colleague chartered accountant. And this one, they're just talking about what? These things that we are discussing. Receipt and payment, and also what? Revenue and expenditure. That's all. So, what is your understanding about the fact that cash is a fact and profit is what? Is an opinion. Can you tell us, do you agree to this statement? And this is how a colleague, chartered accountant, was just baffling, was just confused. It's not that he doesn't know it, but he was just confused. And that's how he lost the job. Yes, he lost the job. Because he couldn't convince them. He couldn't convince the panelists that it is true that cash is a fact and profit is what? An opinion. Because in arriving at your profit, there are some non-cash transactions that you take into consideration. For example, depreciation, provision for depreciation, provision for doubtful debt. All these are non-cash transactions. All they want you to tell them is that when you are preparing your financial statement, particularly statement of comprehensive income, there are some items that you will include in it. And you should mention them. But when you are preparing your cash flow, or when you are preparing your statement of receipt and payment or cash book, those items will not be what? Included. They are not cash items. And when it comes to the determination of what? Depreciation rates and so on, this organization, this company will say, oh, the way we are using this particular asset, we are going to depreciate it at 20% or 30%. What is their way of doing it? This one will say, oh, the way we are using this vehicle, we'll use 10% or 20%. So the organization have what? Different what? Ways. Different ways, different opinions, different ways of what? Handling some of these non-cash transactions. And it goes into the preparation of what? Their financial statement. But then, when it comes to cash, cash is a fact. 5,000 here in this company is the same what? 5,000 in another company. So you should be able to know some of these things so that you can talk to it. You can talk to it. So that is about, you should know the difference between statement of our comprehensive income. That is what the private sector, they use. So if you are preparing your financial statement, you are looking at statement of comprehensive income or statement of what? Financial performance. How have we performed over the period? And the result is what? Your profit or your loss. Are we okay? The result of preparing statement of comprehensive income is your profit or your loss. The result of preparing what? Statement of financial position is to know your state of affairs as far as what? Your finances are concerned. Is the organization highly geared or lowly geared? So when you prepare your financial statement at the end of the day, and you send it to the bank and say, oh, bank, I need a loan. For the bank, the main concern of a bank, if they want to grant you a credit facility, they go straight to what? Your financial position. Before they come into what? Your statement of comprehensive income. Why? The bank will want to know whether you are highly geared company or lowly geared. You're taking a lot of loans, like some of us. We are taking loan from B port, from A port, from all kinds of ports. Yes. So when you need money and you want to go for another loan, they are asking for your what? Huh? Financial statement, or I'm talking about the individual, or no, you people, you don't take loan with controller. Thank you. You are there. You're looking at what? You affordability. Can you afford? Can you afford? So when you go to the bank now, they will ask you, can you afford? They are looking at what? Your financial statement, your financial position. Do you have a lot of debts? It's your balance sheet that will tell us whether you have a lot of debts, you are highly geared or not. The financial statement will tell us. Then cash flow, the in and out of what? Cash. The various components of cash. Is also concerned for what? The banks a lot. Then statement of what? Changes in equity. Statement of changes. This one particularly does not affect those in the public sector. But then those in the private sector, they prepare this one, a statement of what? Changes in what? Equity. What has changed over the period? Have we issued new shares? Have we paid dividend? And so on. Is there any right issue? Bonus issue? Has it affected our what? Share structure, shareholding structure over the period? Has there been proposed dividend? Interim dividend? Paid up? All those paid up capital, all those things will feature here. And these statements are what we normally refer to as the components of a financial statement. Hello? So at the stage of summarizing, we are preparing all these statements, and these statements are what we call the component of a financial statement. They are different from the element of a financial statement. Hello? The component of a financial statement are different from what? The element of a financial statement. So when we say summarizing, this is the end result of summarizing. So the transaction having been posted are classified in accordance with the concerning ledgers are then summarized in a particular manner in order to prepare the following statement as we have seen here. Then the next stage is analyzing and what? Interpreting. Interpretation of the financial statement. It says that this is the final function of what? Accounting. The basic function of accounting is what? Recording. And the final one is what? Analyzing and what? Interpretation. The recorded final data is analyzed and interpreted in a manner that the end users can make a meaningful judgment about the financial condition and profitability of what? The business operation. Good. That's about interpretation. Again, it says that this is the final function of accounting. The recorded financial data is analyzed and interpreted in a manner that the end user can make, okay. Then, since accounting is regarded as a business language, it provides necessary and the required information to its user through which profitability and the financial position of a business may be what? Ascertained, which in turn will be very much useful for planning and what? Establishing various what? Policies. Then when it comes to, we are talking about interpretation. When you interpret, you have to what? Communicate. So after having been analyzed and well interpreted, the financial information is communicated to what? Intended what? Users. The process undertakes preparing various reports, including the chief financial statements, such as the cash flow, ratio analysis. We'll come and look at it. Interpretation of what? Financial statements. We'll come and look at ratio analysis. We'll come and look at other models of what? Interpreting financial statements and so on. So in a summary, we are saying that the process of accounting involves recording. And where do you record? You record in what? In a journal. It goes on with classifying. And what do you where do you classify? You classify in what? By preparing ledger what? Accounts. They are all books. Then summarizing talks about what? Preparing your trial balance and then eventual preparation of the financial statement. What are the objects? The objective of accounting is to maintain systematic record of what? Of the business, to ascertain profit or loss. That's the major purpose of what? Accounting. To ascertain profit or loss. To ascertain the financial position of the concern, the nature and the value of the assets, the nature and the extent of what? The liabilities. It helps a lot to facilitate rational what? Decision making, and to make information always and all the time readily what? Available to various groups and users at a particular time to facilitate what? Rational decision making. How important is it to all these interested users? Accounting is so important to what? Users with direct financial what? Interest. Very important to users with what? Indirect financial interest, and also very important to what? Management. So to management, we are looking at the directors, the officers of the company, managers, and departmental heads and all that. So if you are a departmental head, head of IT, head of procurement, head of HR and all that, you need to know something about accounting. Very, very important. And to help in these decisions, assessing the profitability of what? The entity. In the public sector, how will it help? Do we make profits when we prepare our statement of financial performance or revenue and expenditure account in the public sector? What is the end result? Is the end result profit or loss? Yes. What is the end result? Yes. What is the end result? Oh, we've just said it. I'm saying that in the private sector, we prepare statement of financial what? Performance or statement of comprehensive income to determine our profit or what? Loss. In the public sector, do we trade in the public sector? No. So in the public sector, we normally or usually prepare our what? Statement of what? Income and expenditure, or revenue and what? And expenditure. And I'm saying that what is the end result? Yes, senior. You are there. So in the public sector, when we prepare our statement of income and expenditure, the end result is not profit or loss. As it's saying, is what? It's either deficit or surplus. So if the accountant prepared the financial statement and the accountant say, we have made a profit, correct the accountant and say, accountant, do we sell goods here? Accountant, why are you saying that our profit is this? Which account is this one? No, I'm talking about those of us in the what? Public sector. In the public sector, all the income, the revenue that you receive from IGF, from GOG, from, other international institutions like grants, donations, and all of them, you add all of them together. Then you take away all your expenditure items. The end result will give you what? Your surplus or what? Deficit. We don't have profit or loss. We don't have profit or loss account in the public sector. Hello, are you with me? So when you go out there, you are mentioning that they mention the right terms, so that they will salute you and say, oh, this manager, even though he has IT background, he is what? He's knowledgeable in accounting issues and so on. So in the public sector, we will use it to assess whether we are making progress in terms of surplus or what? Deficit. So under what circumstance would there be a surplus? When all your revenue items, the IGF, the GOG, the grants, the donations, when they are more than what? When they are more than your expenditure items. Expenditure items in the public sector, we are saying they are what? Number one is your personal what? Personal emolument. Now it's no more personal emolument. What is it? What's the technical name for it? Oh, personal emolument. Now is what? Compensation of what? Employees. Please. I'm saying they become majority of us are in what? In the public sector. So when you see these things, the accountant say compensation of employees. You should understand that it is what? Wages and salaries. Hello? In the public sector, compensation of employees is the same as what? Wages and what? Salaries. So when accountant prepare a financial statement and a statement of revenue and expenditure, you are looking at all the revenue items, beginning from what? The GOG, the IGF, the grants, the donations. Then you let all the expenditure items, particularly the discretionary expenditures, such as what? Your salaries and wages. But the accountant in the public sector will say what? Compensation of what? Employees. It's the same as what? Salaries and what? Wages. Or some of them are still used to the old one, which is what? Personal what? Emolument. Then you see payment for goods and what? Services. Goods and what? Services. And also at times you see other expenditure items there. Then at the end of the day, you now see the end result. All we are saying is that if your expenditure, if your revenue items are more, or your revenue is more than what? Your expenditure, then we have what? Surplus. But where your revenue, your income is less than what? Your expenditure, then we have what? That is all. So you should know this. So it help us make these decisions. Profitability, decision, liquidity, gearing, financial performance in terms of plans and so on. Then users with direct financial interest. Who are the users with direct financial interest? We have the present and potential shareholders. That's for the private sector. Shareholders. But then in the public sector, the direct financial interest holders are, who can tell me? Direct, yes, who can tell me? Direct financial interest. Yeah, we are talking about in the private sector, we are talking about present and potential what? Shareholders. Present and potential shareholders. In the public sector, it will be what? The government, Thank you. And that's also another addition. The government and what? Development partners as well as what? The investors. Now they see the investors say they won't come to Ghana again. Why? Why? Because of what? LGBTQGSYZ plus. So present and potential what? Shareholders, creditors, employees, suppliers. These are the stakeholders that have what? Direct financial what? Interest. And they make decisions like this: share investment decision, credit decision, assessing the company's status and prospect, and approving what? Supply decisions. Are we okay? The users with indirect financial interest. Yeah, the customers, tax authorities, financial analysts, labor unions, consumer groups, the press, and also the general public. And their decisions regard particularly the tax authorities. They are looking at how they can assess your tax obligation or tax liability, protecting investors and the public, in advising on investment decisions, certain economic decisions, and so on. So in summary, we are saying that the users of accounting information, external users, they are the investors and the security analysts and so on. And then the internal users, good. They are the shareholders, managers. So let's get the distinction very well. The shareholders, the managers, and also what? The employees. Now, this is very, very important for us to know that external users, they make decisions. What is there? External users, they make decisions about what? The entity. When we say about the entity, what do we mean? Yes, I've been talking. You two talk. Yes, about the company. So that about the external users make decisions about the entity. It means what? They make decisions about the entity. And then internal users make decisions for the entity. So the words here, critical words here, about and for. Yes, senior. Perfect. Perfect. Good. I like that. Thank you. Thank you. Yes. Okay, that is the external users. Okay, good. Yes, senior. Okay. The entity. Okay, it also have them making. Yes. Good, good, good. I love that one too. Their decisions. Yes, honorable. Okay. They make direct decisions that affect the operations of. Yes, senior. For themselves. Okay, for themselves. Good, good. Good, good. So the external users, they make decisions about the entity. And they need the information before they can make decisions as to whether they want to invest or not. But whatever decision the internal users will affect the company directly, as senior says, directly. But these people, their decision affect what? The company indirectly. That's why he's saying that external users make decisions about the company. And then internal users make decisions for the company. So the fundamental relationship in the decision-making process involves events and transaction recording. We are also talking about the same thing that we. Now, the information that we put out there for interested stakeholders, internal users, external users, and so on, we are saying that it must have some kind of characteristics or features so that the interested parties or users of financial information can be able to use the information very well. They will understand the information and use it to make what? Informed decisions. That's why he's saying that the demand for accounting information by investors, lenders, creditors, etc., creates fundamental qualitative characteristics that are desirable in what? Accounting information. It goes on to say that there are 6 qualitative what? Characteristics of accounting information. The information that you are putting out there as an entity, as an organization. What will be some of the features? What should be some of the characteristics of this information so that it can be useful to what? The interested users or interested parties. You don't just put out the information there. If the parties who want to use the information, if they don't understand the information, can they make proper use of it? Of course, no. So there are some basic qualitative characteristics that every accounting information should have. And he's saying that 2 of the 6, the characteristics, basically they are 6. And we are saying that 2 of the 6 qualitative characteristics are what we call the must-have, the compulsory. So the moment you prepare your financial statement, these particular 2 characteristics, they are the fundamental characteristics, basic foundational characteristics that we need to see in it before we make what? Informed decision. While the remaining 4 qualitative characteristics are what? Enhancing. They are beautiful, nice. They are the secondary. The primary ones, they are 2. We call them the fundamental what? Characteristics of accounting information. Then the secondary one, they are what? 4. Secondary, primary, very important, very critical, very essential. Good, let's look at them. Qualitative characteristics of accounting information that must be present for information to be useful in making decisions. These 2 are relevance and what? Representational what? Faithfulness. Relevant. We are saying that the financial information must be relevant. It's a primary characteristic. Financial information must be presented faithfully. Represented faithfully. When we say relevance, what do we mean? Qualitative characteristics. Okay, these are for the enhancing or the secondary qualitative characteristics. We'll look at them one by one. It says that for the secondary, the information must be what? Verifiable, timely, understandable, and also what? Comparable. Relevance, when we say financial information at the very basic level, primary feature, we are saying that relevance refers to how helpful the information is for the financial decision making. Everything becomes relevant if it is what? Helpful. For accounting information to be relevant, it must have a confirmatory value. Confirmatory value. We should be able to what? Confirm whether this particular information is what? Is real. Confirmatory. Provides information about past events. Oh, we have bought so much assets costing us 500,000. Is there a proof to that? Can we confirm it? Oh, this is what? The invoice. This is the invoice. And that is what auditors do. This is one of the basic, auditors who are interested in what? The financial information. So for the auditor, when he comes to do audit, he say, accountant, bring your financial statement. That is not enough. Accountant, bring your value books. What is the essence of bringing the value books? In the public sector, they say value books. When we say value books, what do we mean? Yes, value books in the public sector. Yes, they are the documents, and some of them are what? Your receipt, good. Your invoice is good. Your PVs, all these are value books. So the editor will say, accountant, bring the value books, bring the receipts. Oh, you claim that you have received so. It's in what? The financial statement. Okay, can we confirm it? Then we'll go straight to the source document. Oh, we have received IGF of so much. Then we'll go straight to the source document to confirm whether it is so. That's what we are talking about. Confirmatory what? Value. We should be able to confirm that it is what? It is so. Then we can see that this particular financial statement is what? Relevant. So one major primary characteristics, qualitative characteristics of a financial information is what? Relevant. And when we say relevant, we should be able to what? Confirm. And also we talk about predictive ability. Predictive value provides predictive power regarding possible future financial transactions. So based on the information that we have, the historical information that we have, then we can predict into the future that, oh, this is what will happen in the future. We are paying so much salaries and wages. We can predict into the future that, oh, if government want to increase salaries by 30%, this is how much we can will be paying as salaries toward our employees. You can predict into the future. Most of the times, if you are preparing budget, particularly line budget, if you are preparing budget, at the end of the day, you see that you need a base which is historical information. When you get the base, then you can add some kind of what? Percentage. You can predict, oh, next year we'll be spending so much on repairs and maintenance or rent or that. That's what we are saying about. Then the information becomes what? Relevant. Good. I don't think information is relevant if it can provide helpful information about the past, past events, and help in predicting future events or in taking action to deal with possible what? Future events. For example, a company experiencing strong quarter and presenting these improved results to creditor is relevant to the creditor decision process to extend or enlarge credit available to the company. Now, when it comes to faithfulness, when we say representational faithfulness, what do we mean? Also known as what? Reliability. So another name for representation faithfulness is what? Reliability. Can we rely on this particular financial statement and make informed decision that at the end of the day, we will not find ourselves in trouble? Oh, the company say we have made a profit of 100,000. Is it reliable? So we are saying that the financial information must be reliable. Oh, we bought this number of assets. This is the value of our asset. Is it reliable? Is it reliable? Is it reliable information? We prepare their cash flow statement, they prepare the financial information statement and all that. Is it reliable? So relevance and reliability are so key, so central in the information. We must see it. It says that it's the extent to which information accurately reflects a company's resources, obligatory what? Claims. Obligatory claims are what? What are obligatory claims? Yes. Oh, another name for obligatory claims is what? Hello. Yes. Yes. What are resources? Company resources. Company resources. They are the assets. What are the obligatory claims now? Good. Liabilities, another transaction. To help think of pictorial depiction of something in real life. How accurately does the picture represent what you see in what? In real life. Reliable. That's why auditors in particular, if they come, they want to test this particular quality to see whether they can rely on the financial statement. You cannot tell me that you have bought, those days it was this box television. These days we have the flat screen. It was in 2002 or 2003 that an audit was conducted. And as at that time, a box television, an entity said they spent about 2,000, those days 20, is it 20 million or 200 million or whatever, yes, in buying this. But they, in the market at that time, it was less than 100 Ghana, 20,100. So this raises what? Questions, suspicions. We can't rely on this particular information. No. You need to confirm from the other sources. I remember this one happened just recently. A colleague auditor, he went out to do audit. We are talking about what? Verifying to see whether the information is reliable. He went out for an audit. So he looked at the invoice. And on the invoice, that this is a secondary school accountant who has paid a supplier of maize, 1 bag of maize. That was about 2019, thereabout. 1 bag of maize, as at that time, was around 300 Ghana cedis. That was even at the time it was high. 1 bag of maize. But on the invoice, one was 1,200. 1,200. So the auditor wanted to test the reliability of this. What did he do? He picked the invoice like this. He picked the invoice. He was in the accountant's office working. So he picked the invoice like this. He said, no. Myself, I know. In the market today, 1 bag of maize cannot be more than 400 Ghana. How come it's stated there 1,002 and they were buying about 100 bags? So what happened? He picked the invoice and said, you want to call the supplier. I want to call the supplier. This time around, he didn't, the accountant was just sitting there, but he just decided that, let me call the supplier in the presence of what? The accountant. So that we will talk, the supplier will be talking. Then you will be asking the accountant, how come this and all that? So that he can confirm. It's also about what? This reliability and what? Relevance. He wants to confirm. So he dialed the number. The moment he dialed the number and the number was going like that. All of a sudden, he just heard, the accountant phone was ringing. Then the accountant was sitting there and say, oh, Mr. Auditor, you are calling me. Then the auditor look and say, no, accountant, I am calling the supplier. Oh, you are not the one I'm calling. I'm calling what? The supplier. It means it's the accountant that supply. And look at it. 300 against what? 1,000 what? 200. Information. And this is what we are doing to Mother Ghana. If I tell you what is happening in the public sector, you will weep. But God will have mercy on us. Amen. So what we are saying is that for information to be reliable, we need to confirm. Actually, that is why when you go out there as a business person, that you need a loan, the bank will say, bring your financial statement. And that is not all. They say, you must bring your audited financial statement. With the audited financial statement, we can, to some extent, rely. Because that is an independent person's opinion on the accounts of the entity. Then we can rely on it. So we are saying that these two elements, qualitative elements, characteristics, are so key: reliability and relevance. Reliability. So before you can make an informed decision of an entity, it is always good for you to make the decision based on financial information that has been audited, particular financial statement that have been audited. Because the auditors, they will go through all these things to assure themselves that this particular financial statement is reliable, is relevant. So don't just jump up and say, oh, we want to use this particular financial statement for our decision making. Please ensure that their particular financial statement is an audited financial statement. And to help you a lot. If the financial statement is not audited, then you have a problem. You have a problem. Good. So again, reliability means that the information is financial statement is complete. Financial statement should not exclude any transaction. Should be complete. And also must be neutral. It must be neutral. The degree to which information is free from bias, know that there are subjectivity issues. So the neutrality comes in. And also free from error. Free from, to some extent, it might be free from error, even though there are some errors that are genuine. What is the difference between error and mistake? What is the difference between error and mistake? Mistake is intentional. And error is unintentional. Yes, good. What's the difference between mistake and error? They say mistake is intentional. What's the difference between mistake, error, and fraud? Error is oversight. Thank you. What about mistake? Mistake too is it oversight? What about fraud? Fraud is what? That one is what? Intentional. Fraud. That one is what? Intentional. Okay, thank you for that one. Yes, it's also incomplete. So we are saying that all these things might be free from error and all that. So when it comes to the secondary features, characteristics One of them is what? Verifiability. Verifiability is the extent to which information. Okay. Error can be an omission, good, or intentional. What about fraud? Good. But all we are saying is that the financial statement might be free from what? Error. Very, very important. So that we can what? Rely on it. Verifiability is the extent to which information is what? Reproducible, given the same data and what? Assumptions. We want to verify. For example, if a company owns equipment worth thousands and told the accountant they purchased, they've been able to save all that. Can we verify it? That is normally the work of what? Auditors. Those are, how many of us are auditors here? Auditors, one of the key things that they don't joke with at all is what? Verifiability. Verifiability. You should be able to verify the information. Whatever information you produce, you give out there as an accountant should be verifiable. We can test it and see that it is what? Real. It is real. Then you have purchased an asset. Can we verify that this particular asset has been purchased? Is there a document to show, to prove, to indicate that this particular asset has been purchased from this particular entity, this particular organization? How much can we verify? Okay, this is the policy of what? Depreciation that we are using in depreciating the asset. This is the policy of depreciation. What is the document referring to what? The policy that the organization has come out with. All these things must be what? Verified. Then another very important one is timeliness. When we say timeliness, what do we mean? Yes. Information must be timely. Okay, as and duration. Time bound, yes. Information must be timely, verifiable. Timely, Yes, yes, you want to say something. Oh, you are warming up. Okay, he's warming up. What about you? You're also warming up. Okay, yes. Yes, senior. Good. When the information, hello, yes, sir. Good. Good. We are saying that information must be what? Timely. As in when it is needed for what? Decision making. If we need an information to make decision, and then we don't get it on time, and after some time, after some years, after some days, that you bring the information, will that be relevant? Will that be necessary? No. We are having a management meeting, and then we say, accountant, where is the cash flow? Or accountant, where is the statement of what? Financial position. Oh, it's not ready. Oh, chief, it will be ready tomorrow. I will fire you as the accountant. Because it's going to affect our decision what? Making process. Yes. So let's talk about the real time, how the information can be available anytime that we need it. So if we need information for a meeting, we say that tomorrow we are going to have a meeting, management meeting. Accountant, when you are coming to the management meeting, bring A, B, C, D data or information, financial statement. And then we come there. And then we see A, B. Where the C is not ready. Accountant, you are not up to task. We have to fire you. All we are saying that information must be what? Readily what? Available. So that we can use it to make what? Informed decision as and when what? We need it. Understandability. What do we mean? We are saying that information must be what? Understandable. You must present it in such a way that an ordinary person should be able to comprehend, understand, make meaning of the financial statement. Make meaning of the financial statement. Anybody at all who have basic financial education should be able to make meaning of your financial information that you put out there. So if we can't understand the financial statement, it's useless. So we are saying a financial statement must be presented in such a way that the interested parties must make meaningful understanding, meaningful, decision based on their understanding. Good. So then comparability. When we say comparability, what do we mean? The financial statement must be what? Comparable. Yes, what do we mean? So that we can make what? Decision. Comparable. Comparability means what? Compare. Two things. You should be able to compare your financial statement. Yes. Thank you. You are there. I like that. So comparability will help us a lot. When we take this year's financial statement and compare it with what? Last year's financial statement, then we will know whether we are progressing or not. Comparability is very key. In 2021, we made profits. We made so much. How come in 2022 we have made a loss of 60 billion? Is it billion or cities? 60, thank you, 60.8 billion. You know what a billion is? You know what a billion is? 60 plus how many zeros? 9 zeros. That's it, so not the old one. No. Not the old one. This is a central word. Where on earth, since independence, that this thing has happened? It's a serious matter. And you see, as MBA students, we need to interrogate some of these things. And when you look at some of the expenditure line items, repairs and maintenance, traveling and transport, and some of them, communication. You look at the expenditure, you look at the amount, they are not even in thousands, millions of what? So what happened? In the name of what? DDEP. In the name of what? DDEP. Look, this one. Anyway, my man is recording me. Otherwise. So what? There are some things that we know. We can say, but it's no good. It's no good. You know, if you say it now, it's in classroom, man. You are tempting me. Anyway, all we need to know is that comparability will help us to make decisions. Now, if somebody now offers you a job at Bank of Ghana that is making losses, will you go? You are not thinking that tomorrow they'll be laying them off, Anyway, so the uses of accounting, ascertain the operations of profit and loss. I think we've discussed a number of these issues. Limitations that accounting records only monetary transactions, which is true. Effects of price level changes is not considered. Anytime there's inflation and those things, accounting will not take into consideration some of these things. No realistic information due to concept and convention. There are a number of concepts and conventions in accounting which are not real. Then personal biases when it comes to certain issues in accounting. And also it permits alternative treatment of accounting, lack of uniformity in some of the principles. All these are what? The limitations of what? Accounting. Our time will fail us to talk about them one by one. Then this one, I think we all know, branches of accounting. We'll talk of financial accounting, and we'll talk of what? Cost accounting, and also what? These are the key and the branches of what? Accounting. So the financial accounting measures and records businesses in order to prepare what? Financial statement. They provide financial statement based on the generally accounting accepted accounting what? Principles. And also focuses on reporting to what? External what? Parties. That is for financial accounting. The focus is to report to external parties, particularly the shareholders, the shareholders, and so on. That's the focus. And the scope is, as we have seen, in the earlier discussion, recording, classifying, summarizing, all these under what? Financial accounting. That is the scope, the whole detail of accounting. This is all that they do. Then cost accounting, that involves what? The process of accounting for cost. How do we account for costs? And in an organization, particularly in a manufacturing organization, even though in the public sector too, we are concerned about cost. It helps a lot. In a manufacturing organization, they really, really do a lot of cost accounting there. Cost accounting, cost and management accounting. They do a lot of cost and management accounting there. So it provides information for both management and accounting and financial accounting. It measures and reports on both financial and non-financial data. So cost accounting report both on financial and non-financial data. We all know of this. The scope talk about analysis and ascertainment of costs. How do we ascertain costs? And for us, we should always be concerned about that, particularly in our institutions, in our organization, wherever we find ourselves. We should be concerned about cost reduction. How do we reduce? That's the second point, presentation of costs for cost reduction and cost control and planning and so on. How do we reduce costs in our various institutions? And I've always been telling my student base that anytime you go out there, hello, welcome, for an interview, promotion interview or whatsoever, management or those who have called you for the interview, they are interested most at times in two things. So whatever question that they ask you in the interview, promotion interview or whatsoever question that they ask, even if it is not related or connected or associated with revenue or cost, your answer must be related or connected to revenue or cost. In that instance, you are telling management that, when I get on board, when I become a director of so, these are some of the policies I'll come out with in order to reduce what? Cost. We are interested in cost reduction. Seriously. We are seriously interested in cost reduction. If you look at the budget for GES, Ministry of Education, very high. And that of Ghana Education Service, very high. GES, I don't know whether you are aware, some of them have written their promotion exams. And up to now, the result has not been released. You don't know. You don't know why. The moment we release it today, it must take effect from what? Today. And the point is that this time around, there were 2 badges that wrote the exams. The promotion interview, 2 badges. And the people that have passed, do we have the financial muscle to pay them their promotion amount? Because the moment you say this person is promoted from principal superintendent to AD1 or AD2, or from assistant director 2 to AD1, or from AD1 to principal superintendent and so on, it must come with what? Money. Do we have it? So the new Director General will want to make sure that if you want to release the result, there must be enough money. And last year, they made a serious mistake of not budgeting this. Otherwise, this thing, the result would have been released from the go. But because of the fact that the implication or the ramifications of releasing the result and it cause consequences is so high. So we need to be very careful. So as a manager, you need to tell us what you can do to reduce cost. If you are not in a manufacturing industry and you are in the public sector, what are you doing to reduce cost? Your staff, they tell you that, oh, this particular stationery item is costing 500 Ghana. I know. There's one particular, what do you call it, professor at the WAC campus, UBITS. When he was dean, before you approve of any expenditure, if you bring this one, oh, this is a pro forma invoice of this particular, before you approve, he will call or he will go to their office and go and find out. What is the purpose? Cost what? Reduction. That's all. We want to reduce cost. So you won't bring a PG and then all of a sudden you say, if you the accountant and say, chief, sign here. You won't mind you. They say, you accountant, go and come. I will go through the document. One by one. You pick all the invoices and so on. One by analyze it and then call to find out before signing. But for some of us, how much is it? Oh, 100,000. You sign. Are you helping the organization when it comes to cost reduction? No. So all I'm saying is that we should be concerned about how we can reduce what cost in the organization and how you can raise revenue, particularly those of us who are generating what revenue, IGF, and so you must know how to manage the IGF, and that will make you become a better person in the organization. Management of your funds, management of your funds fundamentally relates to how you reduce costs and raise what revenue. If you can do that, you'll be a good manager, and that's what we all want. Good, and that's the essence of this course. You are learning all these things, so that even if you are a procurement director or IT director, and so on, you are learning how to reduce costs. What you can also do to increase what revenue. The management accounting measure report both financial and non-financial information. That helps management to make what decision to fulfill organizational goals. The scope is all about this: financial accounting, interpretation, cost accounting. It involves everything. Management accounting. Good. And these are some of the differences between what management accounting, financial accounting, and also what cost accounting. For reporting, it is for financial accounting is generally done at the end of the year. We prepare financial report. But when it comes to management and the cost accounting, as and when it is what needed, then we prepare the information. And when it comes to publication, it's by law published in the case of company and the Companies Act. What is the Companies Act now? Hello? What is the Companies Act? The Companies Act. This MBA class, Company Act is what? Come again. (197) Is it 197? The companies, it used to be Companies Code at 179, but it's no longer a code. It's now an act. Are we okay? We have replaced the act. It is now at what? 99 what? No, not 997. Hey, who can tell me? Somebody say Google. Yes. 992 at 992. Please no distance. So it is required of companies to publish their accounts. Financial accounts, financial statement, it's required of them. So every government institution, government organization is supposed to publish their account. And that one is stated in the PFM, Public Financial Management Act. What is the Public Financial Management Act? Hello, PFM Act. You see, it's because majority of us are in the public sector. No. The Public Financial Management Act. Hello. Majority of us are in the public sector. And this particular act is the act that regulates what? Public financial management, financial issues, all these things that we are discussing here. They are all there. The PFM, how many of us are accountants? Raise your hand. Accountant in the public sector, let me see by hand. They will raise their hand. The PFM Act, the Public Financial Management Act, at 921. At what? 921. At 921. Of which year? 2016. Requires all public sector institutions to prepare what? Financial statements for the Auditor General to what? To audit. So at the end of the year, you are supposed to prepare your financial statement and give it to the Auditor General. Again, the Constitution mandates the Auditor General to audit all government or public accounts and then report to Parliament. Thank you. Report to Parliament every year. So the Auditor General has that particular duty to audit all the public. So the moment you are done, you submit your accounts to the Controller and Accountant General, the accountant of what? Government. Who is the accountant of government? Who is the HR of government? Who is the HR? Article 194 of the Constitution. Hello. In this MBA class, if you want to enjoy the class, then you need to hold on to the Constitution of the Republic of Ghana. Are you okay? And next time, before we start the lecture, I will inspect it, whether you have one, and I'll give 5 marks for that. Okay. Because every is compulsory by force. Every MBA student here, particularly those of us in the public sector, it is compulsory by force that you should hold on to the Constitution of the Republic of Ghana and read chapter 6. You must know it. What is in chapter 6? Is it oil? Everybody must know chapter 6. Anyway, that's about that. So in the public sector, we are saying that it is required of the Constitution and also required of the Public Financial Management Act, Act 921 of 2016. Good. What is that? Yes, good. That's Article 194. The Public Services what? Commission. Yes, I left it out. The Public Services what? Commission. Yes, so he's right. I'll give that person 5 marks. Abdul Rahman. 5 marks, Abdul. Good. There.
Thank you. I'm grateful.
5 minutes. More. For us to close. Hey, is the professor around? For us to close our lectures. I beg you. So information recorded is monitoring for monitoring forms of and all that. Good. Hey, why? It's not going. Good. Okay. Fundamental terms in accounting. When you say business transactions, an exchange of money or money values worth this and services between two parties is called a business transaction. And the transaction, as we said earlier on, will have what? Cash transactions and also what? Credit transactions. So the moment we say cash transaction, we are referring to all transactions that relates to what? Cash. Are you okay? Actual cash. Then credit transaction, when payment is postponed to future date. These are the elements of a financial statement. The element of a financial statement, as I said, is different from the component of a financial statement. So financial statement, the moment we mention assets, and this one particularly, we are looking at the element of the financial position. Financial what? Position. Or the balance sheet. In the balance sheet, you will see assets, liabilities, capital. That's in the balance sheet. Then, when it comes to the statement of comprehensive income, or in the public sector, revenue and expenditure, then we have income on what? Expenses. Asset, basically, we say is any fiscal thing or right owned by an entity which has what? A money value, monetary value. And they are the resources owned by the business which are expected to give benefits, benefits in the future. These are what? Assets. Are we okay? Technically, we say an asset is a present economic resource. That's the technical definition. You say it's a present economic what? Resource. Controlled by what? The entity as a result of what? Past what? Events. An economic resource is a right that has the potential to produce economic benefit. So if you have a building, if you have what? A car, if you have plant and machinery, all these are economic resources that are controlled by the entity. As a result of past events, we bought it and we are using it to bring what? Future economic benefit to what? The entity. So we have fixed assets or non-current assets held on long-term basis and also current assets. So you'll be hearing accountants, and those of us who are not accountants, they say fixed asset, fixed asset. Oh, go and bring the fixed asset register. You, the director, you should know what a fixed asset register is. So that when you see cash in a fixed asset register, you should be alarmed and say, oh, accountant, there is cash or stock in a fixed asset register. Then it should be a problem. You can interrogate. You will not be saying like that director who said that, oh, my accountant didn't advise me. No, you won't say that. Please, are you okay? So we have fixed asset or what we normally refer to as non-current assets. Non-current asset and also what? Current asset. So these are some of them. Non-current asset or fixed asset. So when they bring the fixed asset register, auditors are saying that we need the fixed asset register. And they say, oh, accountant is not around. They come to you as a director. Oh, director, we need fixed asset register. Accountant is not around. You yourself, you can go to accountant office and go and pick what? Fixed asset register. And say, auditor, take. Auditor say, hey. So director, you know this. I say, yes, I am an MBA holder. Yes. So fixed asset land, building, equipment, goodwill, land, building, equipment, and the rest, and they are all fixed assets. Then we also have what? Current assets, stock, inventory, receivable, cash, bank. All these are what? Current assets. You should know the difference between the two. Good. Liability. Please, we need to know these terms because as we progress in this particular course, we'll be making reference to the assets, current asset, non-current asset, liabilities, long-term liabilities, current liability. All these things will be used. So it is not that time that will be saying, oh, what is long-term liability? What is an asset? What is current asset? No, you should know them. We are saying that these are the items that constitute current asset, and this one constitutes what? Non-current asset. Yes. So what is goodwill? See if we can throw more light. Goodwill is also a non-current asset, but we say it is an intangible word, non-current asset, intangible. You can't see it. You cannot what? See it. But then, how do we as accountants value a non-current asset like goodwill? And if you put it there, if you are preparing financial statement and say, oh, goodwill of what? 10,000. What do we mean? At the very basic level, we say goodwill is a good name of a company. That's the normal knowledge we have about what goodwill. But for accountants, if you want to value goodwill of the entity, we are saying that when your purchase consideration, is more than the net asset of the company, then you have what we call goodwill. Hello? Then you can put the figure there. If your purchase consideration, your purchase what? Consideration. Purchase consideration. You are buying a particular entity, particular organization. Are we okay? Now, if your purchase consideration, let's assume is 10,000. And the net asset of the company, net assets. What is net asset of the company? Net asset simply means that all your asset, total asset, minus what? Total liabilities. That is what belongs to the owners of the company. Hello? Total asset minus total liabilities will give you your net worth asset. So this is what belongs to the owners of the net asset is the same as equity. Net asset is the same as what? Equity. Because when you write your accounting equation, you say asset equal to what? Capital plus what? Liability. Asset equal capital. So if you take all your assets minus all your liability, what are you getting? Capital. So capital is the same as what? Net asset or equity. Are you okay? So it means that all your assets minus all your liabilities will give you what? Your capital or your net asset of the company. So if the net asset of the company, the owner's worth, the owner's equity, if it is 8,000, and you are going to acquire the company, you want to determine the goodwill of the company. This minus this will give you what? 2,000. So this is what belongs to the owners. And then you are paying more than what belongs to them. The excess is your goodwill. So this is what? Goodwill. So when you are preparing your financial statement and you want to determine your goodwill, we are saying that it's always purchase consideration less what? Net asset of the company. So the excess of purchase consideration over the net asset of the company will give you your what? Goodwill. The reverse, on the flip side, the excess of net asset over the purchase consideration will give you what we normally or usually call a gain on bargain purchase and not negative goodwill. Hello? Are you getting the difference? A situation where we have the purchase consideration to be 6,000 or 7,000, and then your net asset is 8,000. You are paying something less than the owner's equity, owner's worth. Are you okay? In that instance, it is no longer what? A goodwill. It is what? A gain on bargain what? Purchase. We have been able to bargain well. And so it's not, in this case, it's not an asset. So those of us in our subsequent lectures, when we come to accounting and we are doing company accounts or group account, we'll look at some of these things. We'll look at some of these things. So you have a gain on bargain purchase. In that instance, it's not an asset, it's a gain. So when you are preparing your financial statement, Particularly if you are preparing the statement of what? Comprehensive income. Then the gain on bargain purchase will come there. But if it is goodwill, it will be in the statement of what? Financial position. Senior, are you okay? Who has a question on goodwill? Are you fine? Good. So we are saying that is about goodwill. And trademark, we all know trademark. It's also an intangible what? Asset. Trademark, patents. Patent. All these are, so 1, 2, 3, they are tangible non-current assets. So goodwill, trademark, patent, and the rest, they are all intangible. The tangible ones, we are saying that one you can see, you can feel, you can touch. Tangible. So we have tangible, non-current asset, and also what? Intangible. Goodwill, can you see it? Patent, can you see? Trademark, can you see? So we have intangible and also what? Tangible. So liabilities, a present obligation of an entity to transfer an economic resource as a result of past event. And these are the amount owed. All those people that we are owing, they are liabilities. They are liabilities. Good. So we have long-term liabilities and also what? Short-term liabilities. Long-term are those that are usually payable after a period of 1 year, and short-term are obligations that are payable within what? Within 1 year. Liabilities. So these are non-current liabilities and also what? Current liabilities. Are we okay? Senior, today let's get in it because I've done the changes so that you get the slides and give to them. Then we have capital. Capital is the claim of the owners on the assets of the business or the firm. It's the excess of assets over what? Liabilities. That's it is what is left of the asset after liabilities have been deducted. It's also referred to as a net worth, as we have seen in this case. The residual interest in the asset of the entity after deducting all liabilities. Then we have what we call income, and that these amounts are received or to be received from customers. So income could come from sales for product, performance of service, or in return for the firm's asset and so on. Good. Then expenses are, an expense is the amount incurred in the process of earning revenue. They are the amounts that have been paid or will be paid later for the costs that have been incurred to earn what? Revenue. There are usually decreases in an asset or increases in liability that result in the decrease in equity other than those relating to distribution to holders of equity and so on. Good. Is that our time is happening? Is the professor around? Hey, break time. So you want us to break? You want to eat? Or you want to go and warm up yourself for the next lecture? You want to warm up, All right. So don't worry. We will end here. And then next week, we'll continue with some other distance. But I'll give this one to you. Next week, we'll finish up with this. And then we'll take a different subject. Thank you very much and good morning. Yes, any question? Yes, madam.